Hey everybody, this is Dave Putz from JKP Holdings here. We're going to get started here in just a second as we have some awesome information to share with you guys. Together, Jack here is going to share some great information about what's going on in the state of the market, what's been happening in his world, what he expects from the upcoming turn of events. We have a lot going on right now. We're not sure exactly what's happening. So I want to make sure that we cover a lot of the information that you guys are all excited about doing. But before we get started, I just want to go ahead and play our introductional video that we got started for everyone here. And let me just make sure it's working. Share. Boom. Let me know if you have any problems hearing it or seeing it. This is Dave Putz from JKP Holdings. Before we get started, I just want to cover some housekeeping items to show you how we reach out to the community and how the community can reach out to us. As most of you are aware, we have a large private Facebook group that was established back in 2014. This is geared towards note investors and it's tons and tons of information. The group is meant to ask and answer questions, with most questions answered by seasoned investors. The group also provides access to our vast resources and tools. We allow other note investors to share their content and post it as long as they contribute to other people's posts by responding to questions or commenting. We also have our Facebook page. Our Facebook page provides you the latest news in the world of note investing. It also has our JKP products and services, our events pages with webinars, and also every Wednesday at 1:30 Eastern, we display our weekly watch party. That consists of previously recorded webinars. We also have our large, newly improved website. Our website main page is some details about us, along with a welcome message. On the site, you can find our contact us, where you can send us a message, or down here in the corner is a way to reach us through Messenger. We have our blog, which has different articles and write-ups about different things in the note investing world, education, and our services. If you're a newer investor and looking for more information, I ask you to fill out a form. We're in the process of creating some short videos on different topics of note investing. So by answering the questions in this form, give us an idea of what different areas you're looking for us to cover. Next, under services, we have our webinars. Similar to our weekly watch party, this is a list of different webinars we've hosted. We also have Sell Your Note. This form here allows you to enter the data about a note you're looking to sell. Please be the primary seller, principal seller, and we will respond within 48 business hours, typically with a bid amount. Also under services, we have our JKP portal. This is just a quick page regarding the portal and has a button here where you can log right in. With this page, you'll see the details about what this portal does. From finding 60 different data points on property to foreclosure data, tax information, county information, over 9,400 REO agents, a rental average for a given property area, and much, much more. We also have upcoming our bid calculator. Will be a condensed version of our large bid calculator users can utilize to help make offers based on their own desired returns. We also have our consulting page. Consulting page consists of ability to reach out to us and get information about what we provide and answer any questions you may have. If you're stuck on a deal or you're looking for help on due diligence, spreadsheet assistance, schedule a call. We also have our products. Our products page shows 2 products here. One is our 13 recommended questions for indicative offers that will list different questions we ask sellers to ensure that we have all the information we need to make an informed, educated final offer. Next product we have available currently is our tape headers defined and bid calculators recommended items. This here is a product that we provided you guys that defines different headers, what they're used for, what they mean, for a better informed investor. It also shows you what you should be having in your bid calculator and why. And lastly, we have our NDA. We have just over 100 available assets right now, from first to seconds to REOs to CFDs. Fill this out, you get a confirmation email, and you'll get access to our NDA form. Once you have that, you'll fill it out, electronically sign it, and then send it to us. We will then give you access to our entire inventory of available assets. Now get ready for some great content.
JKP Holding.
All right, everyone, let's stop that share and get on to the good content tonight. So want to introduce you to a man I've known for quite a while, very intelligent, very experienced, from all different kinds of worlds, Jack Krupey. Thanks for joining me, Jack. I appreciate you coming on today.
It's great to finally do this. Thanks for having me.
No problem, man. So Jack's been in all different kinds of area of real estate. So I want to kind of quickly give a small background of what he's in, and then let him jump in and explain a little bit more. Feel free to post any questions on the Facebook live feed, and we're going to do our best to kind of juggle that information. With that, Jack started in traditional real estate. I'm sure a lot of you guys have either started in, brick and mortar rentals or fix and flips and whatnot, and made your transition into notes or other real estate. Jack did a similar thing. In 2010 or so, he transitioned to starting his own company, started buying notes, onesie twosies to branching out. He then that fund grew into immense size, a little over, I believe it was 30,000 loans at one point, about $3 billion, which is amazing abilities to go from where he was. Now he's on his own. So if you're looking for different avenues of exploring and ask some larger questions that some people in our space can't answer, Jack's the person to reach out to. So he's now created, we call the Fund of Funds. So Jack, can you fill us in a little bit about what you've been doing, where you came from, and a little more experience about what you've done?
Sure. Thanks for that, Dave. So as far as how I got into real estate, it started in 2001. I had just graduated college during the dot-com crash and had a degree in information technology. So, it was, I'd had a job, but I wasn't really happy. And, there was a number of years where the IT industry wasn't exactly what it's become in recent years. So I actually went to Vegas and bought I saw Vegas, I saw the money and the glitz and the glamour, and I bought a book on real estate at Hudson News before my flight home. And I think it was called How to Make $1 Million in Real Estate. It was one of those little $20 paperbacks. And got back, and I was living in Rochester, New York still right after college, even though I'm from New Jersey, same town as you, Dave, as many people know. And I called my college landlord, and at the time, this was 2001, 2002, and he had about 18 properties and was renting to college students and flipping houses. And back then, if you could fog a mirror, you could get a mortgage. So 21, 22-year-old kid got within a couple of weeks, I bought a 2-family house, and a couple months later had another one, and within a couple of years, I had 18 doors and had quit my full-time job and was then wholesaling, flipping houses. I ended up getting my broker's license and really just kind of jumped in headfirst with real estate. 2008, I definitely took some hits. The business lending froze and it just became very difficult to operate. So ended up moving back to New York City and ended up at a private equity fund that was buying non-performing mortgages. So my first foot into the non-performing world space was at a fund, and they needed real estate people at the time. So I learned the business from the inside, handling incoming short sale inquiries, deeds in lieu of foreclosure, modifications, and loan sales. And some of the people I'm still in touch with today were some of the other early adopters that I met through selling loans to them in 2008 at the height of the financial crisis. Fast forward a few years, I left that and had my own firm, Gemini. I know some people still remember, we were early in buying and selling non-performing loans. And in 2014, we partnered with a private equity fund. And, it started off, it was just a random meeting off of LinkedIn inquiry. It wasn't something we sought out. It just sort of happened organically. And it was a fund that had historically been in other parts of the distressed debt space and credit cards, and they wanted to get into mortgages. And we did what they call the $5 million science experiment. And that 5 turned into 10, turned into 50, turned into 100. We merged them in 2015 and became a majority owned subsidiary, but I still maintain some ownership. And over the next 5+ years, did $3 billion in transactions, and it was pretty amazing ride. The business is a different business, and we can get into it later. At that size and scale, it's a completely different business than what it was in 2012, 2013, when I was buying 5 loans from Condor and trading with Granite, and it's a completely different world. Being an entrepreneurial guy, I left in 2019, took some time. I did an executive MBA at Kellogg. I did their global program. So I spent most of last year traveling, including Hong Kong, Singapore, Tel Aviv, Japan, Korea. I really just saw the world and took a number of classes with a bunch of amazing executives, and also relocated to Puerto Rico, which has some amazing tax benefits. And depending on what happens next Tuesday, some of you may want to join me down here in Puerto Rico. And then, sorry, this is a long intro, but so what I'm doing now is, the last 3 or 4 years, I've been investing in real estate syndications on, with my own personal money. And, these are, middle market apartment buildings, 100 to 300 units that are generally too big for the average individual investor, but still too small for REITs and private equity funds. And it's a super, super inefficient market because everybody raises money deal by deal and generally has 30 days to do it. So, and what I found is I knew a couple other people that you had to make a choice. Do you put 50 or 100,000 in a deal in Charlotte? Do you put it in Atlanta? Do you put it in Phoenix? Do you use one operator that you might know? Or do you, do you try someone new? And so what I decided to do is create, somewhat of a fund of funds. It's really a fund of syndications or a fund of joint ventures where, and it's called the Diversified Real Estate Fund. And we actually aggregate capital and invest into various syndication projects. And so far we're in a deal in Augusta, Georgia, Jacksonville, Florida, soon to be Lawrenceville, Georgia, and Phoenix, Arizona. And when all said and done, we'll probably have 10 to 15 different projects in different markets with multiple operators. So you have a lot of diversity, and it's something I'm really excited about. It's a good fit for my, kind of the next step of my life and career. Because I've always been an evangelist for the real estate industry, first rentals, then notes, non-performing loans. And now this is sort of, I'm not out of non-performing by any means, and I still consult in the space, but it's a natural progression. I'm pretty excited about, also launching this as the next step in my business.
Amazing. You came from someone who just got into real estate, read a book for a plane flight, and now where you're at is tremendous. So let's talk to both spectrums of the investor here. You have the person who's just getting in and the person that's done $5, $6, $7 million. For the person getting in, what's your real quick one piece of advice for that person?
I mean, you got to network. You have to find a mentor. You have to find trading partners, and you have to be you just have to give value and get value. If you're new, most people that are new are probably not completely new to real estate at all. Usually non-performing loans. So usually it's the second step. Usually somebody's done something first, like flipped a house or been a wholesaler or do something. So figure out what you're good at, and if your skill set is sort of due diligence, if you're not if you're more analytical and not someone who's gonna, shake 100 hands at a conference, which during COVID might, maybe the conferences don't happen live anyway. But if you're more analytical, partner up with someone and do some due diligence. Offer to work for free. Offer to collaborate. And if you're more of the outgoing hustler and you have deal sources, but your eyes glaze over 5 minutes into an Excel spreadsheet, find someone that needs help sourcing deals and that's willing to pay finder's fees to people who can shake some trees and get product, get some loans in front of them.
So now you've done, you may hold 100, 200, 300, 500 notes or rentals. What is the next step for that person to make that move in transition?
It's an interesting time in the market. To be honest, I had a conversation earlier today about diversifying. Back in 2009, 2010, a lot of people were diversifying into loans because the REO markets were being invaded by, Blackstone, Invitation Homes, Colony, American Homes for Rent, and a business that had been sort of a mom and pop business for 20, 30, 50 years and turned into an institutionalized business. To some extent that happened in the loan market too. And when we talk about what the next, what happens over the next year or two, I mean, it's a different market than 2008. And I don't think 2008 is going to repeat itself, at least to that level on the residential side. So there's a lot of sophisticated players, and at the larger scale, it's a very competitive market. And the returns in some cases get worse as you buy larger and larger deals. So for the average investor that's certainly non-institutional, that's using their own money or friends and family money, it's still going to be, there's still product out there, but what we're getting is we're getting kind of the fallout of the institutional trades, the stuff that doesn't necessarily fit the box for a securitization, for example, or is a lower balance, or usually there's some hair on it. I think I could quote, I think Built by Mel, I think in one of his presentations said, you got to be prepared for hair. Which offended me a little bit. I was triggered by that, but it was, I think it was a very, very valid point. So I guess the point is you've got to be flexible. Right now, given foreclosure moratoriums, some of the best pricing on deals may be to buy in New York or New Jersey. A lot of people just have these hard and fast rules. I don't touch New Jersey. I don't touch New York. And certainly there's some value to being very careful in those markets, but you need to be flexible. Institutions can't touch contract for deeds. I haven't had the greatest experience with them, but I know some people who have. And lower balance loans where you have to be a little more careful because sometimes there's a minefield. But a lot of times there's good quality loans for 30, 40, 50,000 as well. But don't expect you're just going to be handed a penthouse in Fort Lauderdale for 50 cents on the dollar. I think that was 2009, 2010. It's not 2018. So be adaptable is I guess the shortest answer I can give.
So let's just get an understanding for those who may not know what you did for the fund. What kind of loans were you buying? Where were you buying from? Were you buying from other funds? Were you buying directly from the government? Where was that fund doing, and what was your role in that fund?
So, I was one of the founders of the company that merged in with the fund. So, we were in charge of all loan acquisitions, in the U.S. We started out small, and those smaller deals, when I said the first 5 million, we were buying from some of the same groups that people in this group buy with. I'm going to be careful with some of the names just because there were NDAs in place, and a lot of the names aren't secret. And then it grew from there, and gradually we started buying up the food chain to larger broker dealers. I can speak because it's public record. We did a number of trades directly with Fannie Mae. That's published on their website, and other trades through consortiums with large broker dealers that would buy the entire Fannie Mae portfolio and sell hundreds of millions to us and various other larger groups. So it really did progress. It was it took 3 or 4 years to really build up. I mean, in 2014, we did a lot of small trades. 2015, we did 3 trades over 100 million with one major counterparty, and it just kind of grew from there. And look, it was a right place, right time with the right group that was looking to deploy capital, and it was nothing I expected or nothing I set out to do. It was literally we were selling loans off of LinkedIn, and I connected with the CIO of this fund, and took a meeting in a hotel lobby because they were in from out of town, and didn't know whether they wanted to buy 2 loans or what, but it turned into something something special. So there's no secret sauce on how it happens, other than like if you put yourself out there and you're active in your marketing, and you create some level of content and thought leadership. Sometimes people come out of the woodwork and seek you out.
You have some fans saying hello to you. I see Bill Mymel jumping in here, and Willie as well. So let's pause for a second on what you've done. I know a lot of people who are on this webinar probably know who you are, what you spoke about. We're in a weird time right now. I know we talked about this previously. Where do you think you're bullish on? What do you think is the golden ticket right now? Where are you transitioning to where you may have not been 3-4 years ago? What do you see is going to be in the next 6-8 months? What are you expecting?
Sure. So I want to start by quoting Howard Marks, founder of Oak Tree Capital, posts some very solid articles and does a quarterly newsletter, kind of like Warren Buffett does. And I read his last book called Cycles, and he repeatedly says, history may not repeat itself, but it does rhyme. And that's really the basis of what I think is going to happen next. I'm actually very bullish on residential housing. I do not think we're going to have a 2008 type crash on the residential sector. I do think there'll be foreclosures and evictions, and we've had moratoriums for months and months, and eventually they'll have to go through the system. But unlike 2008, most of these loans were actually underwritten with some level of standards. I'm actually buying a condo myself right now, and it's not easy. They're running me through the ringer, and I've got a reasonable amount of income and assets at this point. It's still a hassle. And I think, there was not the level of sophisticated capital to buy loans in 2008. There was a lot of people figuring it out. Some of the major firms that were in that space beforehand had too much exposure to subprime and were losing money. And it was really new firms or new divisions of bigger firms set up to acquire non-performing loans post 2008.
So you're saying that those people buying loans back then were much smaller pond than they are now, that these people now developed out to much larger operations.
Yes.
They can acquire loans.
Yeah. Also, the loans that were in foreclosure in 2008, a lot of them should never have been written. In this situation, even if there is there's going to be a kick up in foreclosures and delinquencies, but many of these people just got caught up in the COVID in something. They lost their job. They owned restaurants, and COVID it also disproportionately hit, I think, a group that probably less of them are actually homeowners as well, which is one of the reasons we're avoiding sort of the Class C apartments, which we'll get to later. Yep. But yeah, I think the reason for default is different, and as the vaccine progresses or the virus kind of as herd immunity approaches, there's the people that lost a job because of this virus pandemic and the economic impact of it. Are likely to get some type of job, and maybe even get a job that's more remote and have more flexibility in location to find some gainful employment. So there'll be foreclosures, there'll be some evictions, but the loans that go non-performing, there's a number of sophisticated buyers with a lot of capital that are chasing, need yield and opportunity. So the loans will be absorbed by the market. I do think there'll be a lot of loans that do trickle down, but what I think is the housing prices, I do not expect to crater. I think there'll be more non-performing loans to buy, more reperforming, subperforming loans to buy by the secondary market, by all of us that buy loans. But I'm actually overall very bullish on housing, because there's never been the supply never caught up after the last crisis, and until the vaccine, until COVID is really done and over with and starting to be forgotten, less people who wants to list their house for sale and have strangers walking through and sneezing and coughing. And, so I think there'll be a continued limit of supply. And I think it's hard to find a single family house. I know a number of people that are, we know a lot of realtors that are handling REOs that they sell very quickly, and it's very competitive. I have friends trying to buy that are putting there's multiple offers on most houses they look at. So overall, very bullish on residential. Commercial, retail, office, that's where the opportunities will be this time around. And the thing about that is that's also a potentially a lot more decentralized of a market. A lot of the residential loans, there were some smaller banks that held loans on their books, but a great majority of the residential loans were sold into either Fannie, Freddie, HUD. They went to Wall Street. Community banks hold a lot more commercial paper. Fannie Mae on the multifamily side, there's still a lot of Fannie Mae, Freddie Mac, but if you have a random strip mall in Ohio, much more of a chance it's with a community bank. So those deals, and some of them are going to go to DebtX and the big brokers but there's going to be some opportunities to find unique opportunities either in your local market or through kind of hustling and finding sources that are available. Those deals take a little bit more creativity in some cases. There's talk of turning vacant department stores into Amazon warehouses or some light industrial. There's a lot more that goes into it. Turning an office building or a mixed use building into more of a planned community, mixed use. Knock down a well-located office building and build 5 apartments or 8 apartments. So there's going to be lots of opportunities, but they're going to require more ingenuity. But the way I've always made the most money with non-performing loans, though, is working with the borrower and getting loans reperforming. So to the extent you could buy a loan on a half vacant office building, readjust the terms so that the owner could actually afford to cash flow it half vacant, and let them do the work of figuring out the new normal and where rents are in that market. And that's probably, and especially if you're out of your own area and you're not experienced in office leasing, which I am not. So it's really the same concept as the point is modify the loan, work with the borrower.
So you bring up the notes, commercial notes. In my experience, I don't see a lot of commercial notes trickling down. Where do you suggest, if people want to try that avenue and have experience, is there a place to go find those commercial notes?
There are a couple brokerages. I mentioned DebtX before, but it's a much more, it's a wider market. There's a few brokerages. Some of those are going to actually go to the other brokerages too. You might see those at the same firms that sell commercial real estate because they have the relationships. So check out the local JLL or the local CBRE. And some of these deals might be too small for those guys too, but that's where I know for years people were asking me about calling community banks. So I was like, it's a waste of time. It's really, they don't really, for the residential side, they may service the loan even, but they don't own it. It's a Fannie Mae loan. And in this case, it's probably going to actually pay some dividends to actually do some marketing dollar for dollars. And the other thing is you could actually back into it through property research too. On the residential side, that didn't really work because the assignment would be to some random trust that really to most wouldn't make a lot of sense. But if the loan is owned by a credit union or a small community bank, you could actually pull the assignment records of all the list pendencies and actually back into who owns the loan. So and a lot of deals are going to come from just standard networking too, other brokers, wholesalers, people that are hustling those deals and trying to figure out how to chase a short sale. You might find somebody trying to work the traditional angle that has no clue you could buy non-performing loans, and with your non-performing loan experience, you might be able to work it at a different angle and make more money than trying to do it the traditional real estate way.
Awesome. And guys, feel free to keep the comments and questions coming. We'll do our best to kind of answer them as we go along. I know that pricing of housing is extremely high, which is odd, right? Back 2008, 2009, prices dropped. And I think that's why we're kind of more bullish on the residential side of it, where the defaults will be different. Um, the crash, the housing crash is not going to be what it was. We're not going to see foreclosures in every block, I don't think. So
yeah, let me point out one other thing too.
Yep.
This is something that came up in, this was more stock related, but I took a value investing course at Kellogg when I was doing my MBA last year. And just some of the statistics about dollar cost averaging in. And this was stock market related, but if you started putting money in 1929, if you put all your money in the day before the stock market crash, it would take you 11 years to get your money back. However, if you put your money in over a course of 6 months before the 1929 crash and 6 months after, you'd break even in roughly 3 years.
wow.
So for those that are worried about COVID and worried about the end of the world, or even if there is a recession, even if prices do back up, if you're consistently looking for deals and putting capital to work over the next 1 to 2 years, regardless of if there is a more of a slowdown, if there's a second or third wave, if there's a shutdown and prices do decline, if you're buying good deals along the way and you have a long-term mentality, you're going to do okay.
So Bill asked the question, what do you foresee the terms of the government coming in and, intervening in the market by extending all these, different programs and whatnot?
Yeah, I mean, and I've heard some, a little bit of ominous rumors or something about like certain plans on the Democratic side. A lot of us, including, Bill, got our start right post 2008 and lived through HAMP and HARP and some of the programs. Like, I can't imagine some indefinite moratorium on foreclosures or evictions, but I can imagine some other government programs. And if they're going to extend eviction moratoriums, there's probably going to be some type of like forced program or some type of structured program where the landlord also gets some compensation or some major tax write-offs for writing off the rent. I can't imagine it's going to be so one-sided. And right now, maybe some of the rhetoric is that way, but once it gets down to it, I mean, it's a systemic risk. And when we were talking, or I was talking to someone, and this is probably March or April, and I'd heard, I think it was Barry Sternlicht was on CNBC and was talking about, they were talking about bailing out commercial landlords, and he made a valid point. You're not bailing out commercial landlords, you're ultimately bailing out Main Street, because some of those largest commercial deals, they have CMBS loans, commercial mortgage-backed security. You know who owns a lot of commercial mortgage-backed securities? Pension funds.
Wow.
And pension funds is now Main Street. Now it's everyone else. So you're really not just bailing out the biggest commercial landlords. So at the end of the day, there's got to be some type of support or assistance or something that's doesn't completely keep the mortgage holders and landlords holding the bag.
And I know you've said to me before about inflation being, real estate being that balance for it. Where do you see inflation in the next 12 months with everything going on?
Yeah, I mean, look, I can't tell you about 12 months, but I can tell you when you're printing trillions of dollars, it can't, I can't imagine, and this is maybe in this crisis, we might get more of a pass than normal because a lot of other countries are also providing some level of stimulus, but just overall over a 5-10 year period, I mean, I can't see a situation where we stop this cycle of just printing money and running a deficit. I think what the U.S. has maybe had 2 or 3 years of a surplus in the last 30, and both parties are doing it. So it'll probably take some type of larger crisis in the U.S. dollar or something where there's more resistance to being the world's reserve currency. Now, I'm no economist either. This is just, but I'm also in Puerto Rico now, and I'm surrounded by a lot of Bitcoin, and other cryptocurrencies that are, very worried about the U.S. dollar long term and want to hedge against issues. But holding hard assets, holding real estate, like technically, I guess if you own the debt, technically that debt's worth less. But if property values do go up because of inflation, then more likely your debt gets paid off faster, which will yield to a higher return. One of the reasons, though, I've pivoted more into multifamily real estate is, first, that I am bullish on the multifamily asset class. And if there's a shortage of single family houses, there'll be more people in apartments too, just because they can't find an affordable deal on a single family house. Secondly is locking in that low rate financing. Most of my assets and my holdings the last 10 years were all mortgage related. But over the last few years, I did start investing in syndications, and leveraged real estate is a very good hedge against inflation.
What do you,
Especially when you could borrow at sub 3%. And if I think rates will stay low for a while, but if there is more significant inflation, housing prices will go up, and you've locked in fixed rate debt.
how about compliance on commercial? How does that compare to the residential space?
I think there's different intricacies on if you're buying a commercial loan. I mean, there's certainly some more intricacies. You need to be worried more about environmental, phase one, and potentially other things. And like, I want to be careful. Like, this is, there's potentially more to it. I'm not, don't go, Jack said, I get a phase one and everything else is okay. But there's certainly some other things to look at, but at the same time, you're also dealing with a commercial borrower. So there's actually less on the servicing side, because you're dealing with a company. There's less servicing regulations on, than you have on the owner occupant side. And, there's, a business that in some cases there may be personal guarantees. In some cases, the actual borrower may have a lot of other assets and really something to lose. So in some cases, they may come to the table and, be willing to make some type of deal because they're more motivated than just to, hide and just delay as long as possible. So there's pros and cons, and it's something I'm continuing to look into as well. It's not like I'm not saying I'm the commercial expert by any means on.
No, I mean, it's definitely a different angle than we're used to seeing or investing in. Just to kind of segue real quick back, and we'll go bounce back to commercial. Someone brought up the question of where residential is starting to get more and more compliance issues and whatnot. Someone asked what your thoughts are with debt collector licenses, statute of limitations, and becoming more borrower friendly. I know that's something that we're seeing a lot of that. A lot of states are more and more getting into the fact that debt licenses need to be required. What's your thoughts on statute of limitations and that kind of stuff to kind of regulate?
Sure. Well, on the licensing thing first, I mean, it's definitely different than 2008, 9, 10, 11. I mean, there's a bit of the wild, wild west then. I mean, I'd even talked to borrowers on the phone myself, some of the early times. I mean, at this stage, I would say 100% use a third-party loan servicer. Whether or not you're going to use the limited servicing where you might actually do some of the collections yourself. I mean, that's a personal decision, but I lean more and more towards, relying on the servicer to do more when possible, relying on foreclosure counsel to get the borrower's attention and not put yourself in a spot where you put yourself at risk. As far as the individual states, it's concerning. And, early on, I think, there was the Georgia thing where if you own more than 5 loans, you need to actually register. I know there's a few other states, and it's just something people are going to have to add to the checklist. It's one of those things where if you're, the people it hurts the most are kind of in that growing middle ground. If you're small enough, most states, if you own 3 loans, or, you can kind of just stay under the radar. And if you get big enough, then you can basically pay for the infrastructure to set up a statutory trust where you basically rent a license from one of the larger banks. So, it's unfortunate, and it's like, it's the middle, it's that growing pains area where you have to, make sure you don't get kind of caught where you're getting big enough to catch, to get on the radar, but not big enough to have the proper infrastructure to do it the way the big guys do it. And the statute of limitations, New York is definitely, I think the biggest risk there. At the same time, the pricing is, the pandemic and other problems going on. The pricing in New York is probably the cheapest of any state, and you just have to have good due diligence. It's worth the price to have an attorney look at the file, and you just got to be, you got to be careful. But there's money to be made.
It's amazing because we've never really gotten into commercial. There wasn't the influx of data tapes of commercial when I got started with you, and now we're segueing into commercial space. For those who are kind of curious, what avenues you suggest or what you're exploring? What different class levels are you going in A's or C's, or where are you getting started at?
Sure. So yeah. So and to be clear, when I'm talking about this commercial, like we're actually buying into properties at this point. I mean, commercial debt is certainly something on the table, but what I've pivoted to is buying into middle market syndications. And Class A is the nicest apartments. Those are the highest end. They've got gyms and pools and saunas. Class B, I'd refer to as workforce housing. Middle class apartments. Often they're built in the 70s to the mid 80s, so they're a little older, but still nice. Maybe there's a pool. The ideal ones we like to buy are ones that are the same ownership's had it for 20 years, and they paint, but they haven't really been improving the property. They just sort of riding it out, collecting everything they can, and they're not managing it efficiently to get every dollar out of it because they bought it a long time ago and they own it for cheap. And then Class C is generally minimal to no amenities, generally lower income area, much more likely to have Section 8, maybe some, kind of more challenging, either way more rural and just sort of lower end, or potentially an area has some crime. And, we generally avoid those. So what our primary focus has been is a Class B, and more importantly, a value add. Something that what I described, where the rents are below market, where if you can spend $5,000 to renovate an apartment, it's going to raise the rent by $100 a month. And if you do that over 100 apartments and you're buying a building at a 6% cap rate, that raises the value of the building by, each unit you renovate is raising the value by $50,000 in some cases. And you do that over 50 units, you've forced appreciation in that building. You've got very low financing right now, so you're locking in with longer term Fannie Mae debt. And the other thing that really, and I was aware of it because I owned rentals when I was younger, but it's all different now that I actually have some assets and other income, is the depreciation factor. You own a 2-family house, you're going to get the depreciation over 27 years, and it's nice little, it offsets some of the rental income. On these larger buildings, and we generally have been doing 100 to 300 unit buildings in joint ventures. You can do accelerated depreciation. You hire an engineer, you get a study, and they look at all the fixtures, and they basically allocate, in many cases, 20% of the value of the improvements in your first year. So there's a deal we're doing right now that's going to close probably next week, that for every 100,000 we invest, we're going to get a $56,000 depreciation tax loss for the first year, where we've owned the asset, a month and a half. And that can offset all other passive income. It cannot offset active income. If you work as a lawyer and you make 200 grand, 300 grand, probably, more, judging by some of the crazy hourly billings I've seen for, you can't offset your current, W-2 full-time income with a full-time job. But if you have stocks, bonds, dividends, other passive income, you could offset all of the passive income. And if you don't have that passive income, you could accrue a loss, which you can then carry forward against future passive income, including the capital gains on selling the building. There is some recapture depreciation, but net, it's a huge benefit. And it's something that, as I've kind of migrated my career, and now most of us, we have some assets, we are investing, we're very conscious of all this stuff. The taxes become a very important issue, and it could become much more of an important issue in 5 days.
Well said. You use the word fund of funds. Can you describe what that looks like, or what to somebody that sounds like a bunch of words? What's that look like?
Sure. So yeah, I created, and by the way, this is the first time all these years I've always had sort of one large backer. So this is the first time that I've actually been able to take outside money myself. And, I'm very excited about it, because I had so many people over the years saying, hey, can we invest in your fund? And, we had big pension funds and institutions, and just, it was something, wasn't even my division. So I couldn't do it. So, because it's the first time, and I've seen it go poorly for some people that, especially with the SEC regulations, we decided to set it up and do everything completely legitimate right away. So we did a Regulation B 506C offering. which allows us to do advertising. However, we only can work with accredited investors. And we have a private placement. We have a portal from the website, from the JCAM Investments website. People can view our private placement and our strategy. And we actually already own, as of next week, we'll have 4 apartment buildings in the fund already. And you can review our offering docs and share classes. We have a fixed return at 10%, or we have an equity return that pays a 6% preferred return. And we do a 70-30 profit split, 70% to the investors, 30% once everyone's gotten their money back. Myself and a few partners get 30% of the profits. And we're expecting to do a mid-teens return overall on that fund. And the fund of funds is, we're not swinging hammers. I've been investing myself in some multifamily deals as a partner, but the key is that the whole market is inefficient. When you have 30 days to raise money, even if you've been around for 20 years, it's always a hustle, and these operators are always looking for somebody who can be there consistently and write larger checks. So we actually use that to negotiate better terms. So if there's an investor who is going to decide between putting 50,000 into our fund or 50,000 directly into a project, we strive to get either a higher preferred return or a piece of the back end, a piece of their general partnership, a piece of their 70-30 split, so that it offsets some of our fees, and that an investor who has a decision on what one or the other is actually getting better terms to go into the project through our fund. And we give the diversity. So we're in 4 different markets right now, and by the time the fund is done, we'll be in probably 10 or 15 different projects. And we also may do a few ground up construction projects if they're very, very, very legit, and we feel good about it. But a majority of what we're going to do is cash flowing value add, so that we have the consistent cash flow with the upside. And I look at it as a wealth management play at this point. I've always been an evangelist, and those who know my personality, I'm a connector. I enjoy talking real estate, and I enjoy helping strong sponsors and operators. I say sponsor and operator independently. A sponsor is a deal sponsor, and they're generally the operator who's actually on site doing the work. They're signing on the mortgage, and they're the general partner of the deal. And I enjoy helping guys like that get to their goals, and I enjoy helping investors. I think there's more of a need in this industry for people to have exposure to alternative assets. I think way too many people have their money stuck in a bank earning 4%, and it's not, frankly, it's not fair to them.
So it sounds to me as you're open for 2 different kind of people to approach you. One, they may have a large deal they're looking to get funded, right? And 2, somebody who's looking to get a good return on their money, where they can get different rates of return based on the risk level of the investment. To me, it sounds like both avenues what you're looking for. Can you explain a little bit more about that?
Yeah, absolutely. So we're always looking for limited partners and investors in the fund. I mean, that's obvious. I know a lot of you may also be raising money for your own funds, or maybe mostly active yourself, but real estate's a team sport. So I know in many cases, if you're an active investor, but you're having a hard time finding deals, and you have an extra 50,000 under the couch cushions that you're unlikely to invest or find a deal for in the next year or two, diversify a bit, and we'd be happy to have you. On the operations side, I mean, we're always looking for interesting opportunities. A lot of what we're doing right now is multifamily. I like the risk return profile on that at the moment, but as things develop over the next couple of years, we're always looking for interesting distressed opportunities, and definitely want to be on the call list of anyone who has anything available. If it's a fit for our fund, there's a chance we would actually be that co-sponsor with you and do a joint venture, and use some of our fund's money along with your money, and actually take a project on a project by project basis. If it's not a fit for us, but there's maybe another group or fund or an individual investor that's more hands-on, especially for smaller deals. The likelihood of deals we would more than pass on is if it's small. If it's like a we're probably not going to flip a 2-unit property. We can do some bridge or hard money lending, but at the same time, there's also a lot of hard money lenders out there now, and that's a market that you used to be able to lend at 12-2 or 13-3, and now it's like 10-2. So a lot of these markets, it's another market that turned institutional, and the capital got a lot cheaper. But yeah, you hit the nail on the head on. Yeah, we want to talk to investors, we want to talk to operators, and I want to catch up. I mean, the greatest part about the last month or two, I've caught up with so many people that I've, met at a conference 5 years ago or sold a loan to 5 years ago. And, the last few years I kind of disappeared because we were, institutional and, it was kind of a different world and different business. So I am looking forward to reconnecting, with everyone. And, I know you have a forum for anyone who wants to get on the mailing list for both of our companies. So, I'd encourage everyone to either sign up on my website, sign up on, Dave's going to have a custom form.
I post it on there. If you want to get Jack's information, the website information, all stuff, just put in a form. We just want to get contact information so Jack can hit you up via email. So he's not getting a million emails at once. He'll just definitely do that, and I'll share his email address, but I just posted the comment on the thread here for you guys. We have a question from Tim Ains asking, what other types of alternative real estate investing are you looking other than large multifamily?
Sure. So, self-storage and mobile home parks are assets we look at. Those are, similar. Self-storage was very recession resistant during 2008. A little more cautious of self-storage now with as many malls and Kmart's and Sears going under, that there could be maybe more of a supply opportunity on self-storage than before. The next other alternative we're likely to do is a senior living facility. We have an operator that we've been introduced to that's been doing this for a number of years, and they build 100 to 120 bed facilities in the Midwest. They're on their 6th or 7th, I think, yes, it's 6 going on 7th project right now. And, when I first was talking to them, I was like, oh, what about COVID? What about COVID? Isn't this a terrible time to be having a senior living complex? But it turns out, because they're new construction, they build them with all the advanced HVAC systems. So the rooms have negative pressure, and they're actually, almost as safe, safer than a hospital, or safe as a hospital with all the technology. And, they build them in markets that are just underserved to the point where there's waiting lists at other facilities where they're generally close to full before they complete. And those deals are roughly 30% annual returns. So starting to approach the level of, I'm sure there's some seconds folks on the call. I don't go a day without someone asking me about buying seconds, and it's a challenge. There's not a lot of supply anymore. They stopped making them after 2000, after 2007.
It's amazing. That's what you started out at, right? You started with the second space and converted over the first. We got a couple more questions for you regarding your PPM. Does your PPM have a limit? Limit you to only multifamily, or would you consider investing in debt? I guess the question from Marco is, would you help fund a note investor to buy a portfolio of performing assets?
So the PPM itself has a pretty broad mandate. It's safer to write in all the possible things you can do, because it becomes much more challenging to adapt it and notify it. So I have the ability to buy any type of real estate. We can do hard money lending. We can buy loans. We have pretty broad discretion. With that said, so far we've put most of the money into multifamily, and part of the reason too is a lot of funds get in trouble because of cash drag. So people raise money, they can't find deals, then they either have to return money and they don't hit their returns, or worse, they don't return the money and they buy something stupid. So at least to build an asset base, we've literally had the multifamily deals and already knew what we were going to invest in, and then raise the money. So the money has been very efficiently invested so far, and so we have a pretty broad discretion. Would we do a note JV? We could. Full disclosure, I still have a consulting relationship with PPR Note Company, Dave Van Horn's group in Philadelphia. So anything of a large scale that's like a multi-million-dollar deal, I work with them. There may be buy and sell opportunities with them over time, but I'm on the right deal, if it's commercial or separate, yes. On a random five loan non-performing deal, probably a little too small for what we're going for at this point. We would also, though, potentially buy small pools. We'd be most likely to maybe buy reperforming ourselves. What I'm not doing is recreating another active business. Part of the reason for the fund of funds is to have a little bit of a more controlled lifestyle at this point, and not what I don't want to do is create myself a job I hate. So I'm being very cautious to that's part of the reason I'm doing larger projects. Is it's easy, in some cases it's easier to have a 100-unit building than a 2-unit building. It's easier to manage a couple thousand loans in some cases when you actually have a servicer that calls you back and really cares when you're a significant client. And that's happened a lot too. I've made referrals to various service providers that have taken very, very good care of me and my company. And then sometimes when you're like a guy with 2 loans, you're just not going to get the same level of attention. So
yeah.
So it's
there's a question regarding: are you focused in certain parts of the country, or are you buying nationwide?
It tends to be the southeast, the Midwest, Tennessee. I like Denver. I like most of Colorado. We're in a deal with Phoenix. So it's generally the southeast through the Midwest, up sort of on the West Coast. Probably not, California, just because the cap rates. There's just so much demand for California that unless there's, unless prices drop to the point where it is like 2009, I just doubt we'll compete in California. I'd rather have, a higher cap rate and a double-digit cash-on-cash return and a solid, mid to upper teens return than stretch to buy something. And it goes the same with New York City. I'm not expecting we're going to be heavy in New York, New Jersey. I think just the cap rates are too low, the taxes are too high. Unless everybody moves to Florida and then the prices in New Jersey and New York get down to a level. A lot of people made money in New York buying in the 70s and 80s when New York was, not what New York became. And, New York is kind of going, backtracking a little bit right now. So it's getting its edge, as Bill Burr said on Saturday Night Live, it's getting its edge again.
Someone asked about a little bit more about PPR. What's the relationship? Who are they? Who is it with? Can you explain a little bit about what PPR does and what your relationship is with them?
Sure. So, PPR has been around a long time. I think David Horn, they've got a great reputation in the industry of buying loans. And I'm a consultant. I do business development for them. I help source loan portfolios, and I've actually set up a joint venture or two. So I'm basically a, management consultant, business development, guy. And, they're a well-known group. It's got a great reputation. They, buy and sell loans. So it's really the reason I'm not doing more direct loan investing myself, because they're very established, and, we've got a great relationship. And, I'm not going to try to recreate the wheel at this point. If I do a significant loan deal, I'm going to do it through them.
We have a Mike Bridges, who I guess is giving a shout out for a couple of years ago. You bought a note from his sons a few years ago when he was Scott Carson Group. So
yeah, I remember Mike. How's it? Great to reconnect. I think I have a different email address than the last time we connected. So yeah, please reach back out. Make sure we stay in closer touch.
Yeah, it's amazing. This space is transitioning very quickly, and COVID changed everything. We've talked many times of what's going to be the next curve and what's going to cause it, and this left field thing happens. Those people are sitting on the sideline right now and waiting for all the crumble and the deal flow to come down. What is your advice to them? Should they just be sitting back, or should they be jumping in right now?
I'd say if you're that scared, put some money in my fund and I'll handle it. No, in all seriousness, I go back to the kind of, dollar cost averaging. If you're getting a reasonable deal and it's well researched at this time, you're not going to, it's very hard to time the market. It's very hard to time the exact bottom. Look, who knows? After Tuesday, we could have 3 things happen next Tuesday. Trump wins, Biden wins, or we have like a year 2000 and we'll be hearing about hanging chads for the next couple months. But one way or another, I mean, there's likely to be stimulus one way or the other. You know, at some point in the next 12 months, you know, the virus is likely to, you know, be somewhat under control or run its course. And you never know, maybe a meteor strikes, maybe there's now an Ebola outbreak. I mean, things can go wrong, and it seems to be happening every 10 or 15 years recently, but you know, you know, find a niche and, you know, dive in and, you know, network and research and go for it. Or again, if you're more passive, I mean, I know a lot of people that I've met at conferences that, you know, think they want to do it themselves, and then after a while end up finding kind of the, you know, the hungry, aggressive, you know, deal maker that maybe doesn't have the capital yet. That's the really good, but has the ambition. And sometimes you're better off being the JV partner. You know, I'm at a stage in my life and career too, where, like I said, I don't want to create myself this operationally intensive business. So I've purposely set up, you know, my business and company at this point where I could be, you know, the wealth manager, the tour guide, the connector, and you know, but I'm able to do that in safe deals that I feel comfortable with, and I'm not going to lose sleep at night over, rather than the most aggressive deal. So the answer is, you know, just figure out what angle you want to take and be honest with yourself on it too. I know a lot of people sort of have this inner feel that they have to be a certain way, even though it makes them uncomfortable. They, you know, maybe aren't cut out to do that. And there's space for everyone in the real estate business. There's plenty of angles and plenty of there's no one right way to do it. Yeah. Plenty of wrong ways to do it, but there's no one right way to do it.
Yeah. And I've definitely done some wrong ways myself over the years. We had a question regarding, can they 1031 into your funds?
Not directly into the fund, but we also have an advisory practice. So you can 1031 potentially into a deal that we would be investing in. And there's situations where we can help facilitate those. So, you know, for example, we might be putting $500,000 or $1 million into a $3 million total raise. And if you have a 1031 for another $1 million or $500,000, you can set it up as a tenant in common. It needs to be enough of a 1031 to make it make sense. Like if you're 1031ing a single family house for 50 grand, it's the legal fees will outstrip it. But you know, if it's close to $1 million, then yeah, you could definitely do it. And you know, I'm not a lawyer to, you know, at that size, you hire the lawyers, they take care of it, the intermediaries and lawyers. But yes, we can definitely be facilitating projects like that. You know, if there's needs arise, and I'd say reach out sooner than later too. Like if you think you're going to sell a property next year, and you know, you want to get to know some of the projects that we're doing, the operators, you know, start now, so that when the time comes and you have 45 days to pull the trigger, that, you know, you're comfortable with you know, the types of deals we're doing, and you get it, and you're not going to hesitate to, you know, 'cause it's going to be a big decision.
There's a question regarding, I guess, Christian, if you can explain a little bit more about using your self-directed IRAs regarding your investments. Yes, can you comment on the self-directed funds, especially since tax advantages don't apply for those, with regards to your investments? I'm not exactly sure what she's asking, but
okay, I got you. It's probably the UBIT issue. Yeah, I will say with our fund, you know, anytime you're using an IRA and you have assets that have leverage in them, you know, you do need to be concerned with UBIT. I can't give an exact number on, if you put 50,000 in with what we have, it's going to cost you this much in UBIT. That's the kind of thing that I would want to have a talk directly with, you know, either our CPA for the fund or your CPA. And, you know, I will advise anyone using self-directed to make sure that's being checked out before they just blindly send money in for the fund. Because like, what I don't want to do is be in a spot where you make a great return and then all of a sudden it ends up half the return because of taxes. You know, I'm in Puerto Rico. I definitely don't like to pay taxes, or not at least more than I have to.
So for those who don't know, why Puerto Rico? You like the women? What's going on down there? What's happening down there?
Yeah. So happily married. The happiest 3 years of my life. We've been together for 15. No, that's a joke. But we've been together 15 years. We've been married for 3. All right. Yeah. So yeah, no laughter. That's what I'm used to hearing. So Puerto Rico has this amazing tax incentive called Act 20 and Act 22. They've actually renamed the program now Act 60. So Act 20, if you have a consulting business, pretty much most businesses, if you're getting a 1099, but basically the key is you're making money from the mainland, you make money outside of Puerto Rico and you live in Puerto Rico, they charge 4% tax, and Puerto Rican residents do not pay federal income tax. So essentially, any consulting business, you can pay 4%. And there's also no short-term or long-term capital gains. So stocks, bonds, anything that's on Puerto Rico sourced income. Now, real estate, however, is still taxed in the US because real estate is where the property is. But management fees and some of the other extra fees do get sourced to Puerto Rico. Yeah, it's incredible. There's a couple thousand of us that moved down here, so there's a great community. It's almost like a mini Silicon Valley. I mean, you have Bitcoin millionaires here, you've got stock traders, you've got internet marketing, you've got like real estate fund advisors, you've got a whole slew of interesting people that have all moved down here. And there's a brief hurricane. We did have the bad hurricane in 2017. That was before I got here. But otherwise, it generally never gets hotter than 85, never gets colder than 75. And, the food is great. I'm trying to watch my carbs, so I'm not really having much rice and beans. But it's great. It's like, and it's like three different, you could live in a golf course if you want, or you could live in Condado, which is like living in, it's like living in South Beach in like the 80s before they cleaned it up.
I got a private question from somebody. They asked me, can you share what your craziest note deal that you've been involved with? Some crazy story. Keep it short, but what would be something you've been involved with that just was wild?
So, I mean, I'll give a quick inspirational one, and then I'll give the, let me start with the one. Okay. I mean, there's been some like loophole after loophole fights where the borrower was just obviously stalling as long as possible. We've had deals where they deeded 1% of the property to a new Florida LLC, and then they filed bankruptcy on the Florida LLC. We've had deals where the husband files bankruptcy, then the wife files bankruptcy, and then the wife's company files in a different district. I mean, we've seen all the, so there's been ones that dragged out for a number of years. We had doctors in a very high-end town in New Jersey that, on actually the Trump golf course, that was just delay. And this was like a beautiful house that we thought was worth $1.5 million. And turned out if we sold it as is, it would have been worth like 800 or 700 grand. So actually that was a deal that, myself, and I don't know if Tim's on here, we were there personally. And we actually had a high school friend who was a great general contractor that came in and did a ton of renovation work. And, we were renovating houses, there's a lot of them that you put 10 or 20 grand into, and it's like a pretty cookie cutter rehab, but this is like, very high end. And then another high school friend that's a realtor. So it was literally like the Jackson Memorial High School team of rehabbers. We could have had like a reality show on it.
I know Jen's on the call as well tonight.
Oh, that's awesome. I accidentally, I don't have the Facebook stream up because when your video is playing, I accidentally like started playing a different video and I closed it in a panic. So now I can't get the page up. But then as far as like a really good story is, I bought a non-performing loan in Maryland. This was probably 2012. The house was worth 500 when he bought it, or at least it appraised for 500. When we bought it, it had a $275,000 appraisal, BPO. And I think we paid 170 for it. It was newly reperforming. I mean, this pricing you don't get anymore, but newly reperforming, and we paid kind of higher than we normally did. I think we paid almost 70% of the current BPO value for a freshly reperforming loan. It was very, very underwater. And, turned out the guy was like a military veteran, was now a government contractor, had kind of gotten between contracts and, just kind of had a little blip and, but eventually, had a decent job and was paying. And, we talked to him at the time, they had a FHA, I think 1023 program where you could basically do a short refinance and forgive principal. So I told him, if you pay for 12 months, keep on track. We'll refer you a mortgage banker and we'll see if we can get your loan paid off. I said, I can't tell you exactly how much you'll save, but whatever the house currently appraises at, and minus closing costs, we'll probably take care of it for you. 6 to 8 months later, the He had had 12 consecutive payments. We got real estate values were improving in Maryland, and the house appraised for 390 grand. So after after closing costs, we ended up taking like a 370-ish payoff, and his payment dropped by like almost $1,000 a month. And we had done a forbearance with him as well, so he wasn't paying the same as he was on the original 500. And we saved him over 100,000 in principal. We made $200,000 ourselves. Wow. And it was a win-win-win. Military veteran, and I was saying at the time that I wish we could have like made like a little movie clip or commercial, and like, if the CFPB ever came knocking on the door, we could at least show a testimonial of like some of the good things, things we do in this industry too. Because I'll still like mention this at an airport, and someone's like, "What do you do?" And I would tell them I'm buying non-performing loans, and they just assume you're like this vulture capitalist. And I was like, no, we actually help people most of the time.
Yeah, the big banks give a real bad name to what we do, or what we invest in. It's amazing the space is what we are, and then the connections, and everyone saying hello. Jen just said hi as well. If you have any final questions, I want to wrap it up pretty soon. But if you have anything regarding his fund, I'm gonna post the form link. Just provide some information. He get you on certain mailing lists and whatnot, and reach out to. So you did mention the word accredited investor for your fund. Can you just kind of briefly sum up for those who may not know what accredited investor is, what that falls into?
Sure. So this is a rule that's been around since like the 20s, I think, after the original stock market crash. So an accredited investor, you need to make $200,000 a year for the last 2 years, or if you're married, you combine 300,000, or have $1 million net worth. That excludes your primary residence, so you can't use equity in your house. However, retirement accounts do count towards your net worth. So even if you're not using your retirement account for the investment, if you have enough in the retirement account and you want to use your non-retirement account money, which because of the UBIT thing, this is definitely better. This is better suited for non-retirement money just because of the depreciation. Although it can still make sense for the retirement side. That's really it. And since we do the 506c, we use a third-party company called Verify Investor. So if someone did want to invest with the fund, I don't need to see your tax returns. I can't see the president's. I don't need to see yours. We use, it's actually owned by attorneys. So you could actually either send a CPA letter from your accountant that just says you're accredited and that's good enough, or you could just literally upload a bank statement or tax return to the, and you can white out your account number, but you can just upload it to the Verify Investor portal and they'll confirm that you're in compliance and an accredited investor.
Awesome. It's amazing how things have changed over the years, and the direction you're going right now is exciting. I think you're heading in a direction that we all kind of follow suit on. Your education, your experience with vast amount of notes and real estate, your successes and your failures. If no one has any more additional questions, I want to wrap up by asking you a question. With everything going on, there's a lot of investors on the call who really don't know where to go, when to go. Is there a way for you to assist them or consult with them or give them a direction on what they should do when they get stuck? Is there any good reading material or podcasts or whatever that you can suggest to them that they can turn to for some good ideas?
I think, I'm always listening to just different new podcasts because I've been diving so deep into the multifamily side, and I've actually done a couple of them. So, Whitney Sewell has a daily podcast on real estate syndication. So if something I said triggered and you want to learn more about that side of it, that's a key one. On the note side, these forums, the group that you run, I think you do better in the forum where you get live feedback in many cases than just podcasts. Networking with as the virtual conferences come around, just listening to the other speakers. I know Bill was on before. Bill puts out a lot of good content too. There was a bunch of 2 or 3 different conferences in the last couple of weeks. You just most of it comes from interacting and being out there and talking one-on-one and building a team of people that you can communicate with, ask questions and speak freely. And that are willing to help each other. And, it's not really competition. There might be occasional time where, somebody outbid, somebody might have got a loan that you're like, oh, I saw that one, I would have wanted that one. But most of the time it's cooperation. There's enough deals to go around, and, a rising tide raises all ships. I've always had that mentality. It's like you sign an NDA for the compliance of it, but it's not really enforceable. So like I was not, because it almost seems like you're the broker chain guy if you start. So I don't get so caught up on other stuff other than doing it for compliance purposes. It's like, there's deals I've kind of done on a figure out if somebody's actually going to make money on a deal first before you start figuring out. And you just, most people, if you're providing value, they're gonna, you're gonna work out a fair deal. So
you mentioned a name. Someone missed the name. You mentioned the name again of the podcast.
Whitney Sewell is the real estate syndication show, the daily real estate syndication show. I'm on December 11th. Apparently it gets 100,000 downloads. So we'll see if it works. I've always been told I have a face for podcasting. So,
so people want to know about Puerto Rico though. What area are you in Puerto Rico, and what are you worried about?
So my address is no. I live in Condado. Condado is a suburb of San Juan. It's right on the beach. It's there's a strip of nice hotels. If you want to live in a golf course community, like Dorado is out about 30 minutes east, and then there's a bunch of areas. 30 minutes west, and there's a bunch of areas 30 minutes east. And then there's Rincon is far on the west coast. That's like more like hippie California surfer area. There's something for everybody. There's rainforests, and there's a zip line. I actually was invited to go on, I think, the longest zip line in Puerto Rico on Sunday. But even though I've lost 50 pounds, I'm still a little bit close to the weight limit for the zip line, so I declined.
I was waiting for a punchline on that one. So
okay. You may have to bleep this, but my friend was pushing me to go. And I said, I can't, really the reason I'm not going to go is I have a medical condition. He goes, oh yeah, what's that? I goes, I'm a pussy.
Oh, all righty.
Yeah, on that note,
it's amazing. Some of the people, you had some people saying hello to you as well on here. I know you're not tuned in on it. You hit by hurricanes. I know someone asked the question of hurricanes and floods. Are you dealing with any of that kind of stuff down there?
There was the bad hurricane in 2017, Hurricane Maria. After that, there hasn't been anything significant. There's little low-lying areas. I mean, that just like Miami, sometimes the roads, I mean, we don't have the same drainage you do in like, New York, but there's parts of New Jersey that'll get a flood on a real heavy rain.
Yeah.
Overall, I mean, there's a Costco, there's a Walmart. 95% of the time, I think I'm, think I'm in Miami because people speak Spanish and English. And then 5% of the time I'm, think I'm in, a third world country.
And real quick, you didn't mention it, but I know this from talking with you. Do you have to be there 365 days a year?
No, it's 183 days in general. I mean, there are other, there's a closer connection test. I mean, I tell people you generally, have to make the commitment to move here. Yeah. It's not a kind of thing where you literally get on a plane Monday, you leave everything else in your life, the wife, the kids, the dog, and you're here on a plane Monday through Thursday, counting your days. That doesn't work. But I mean, if you're substantially moving here and you're here 6 months in a day, but you spend, a couple months in the States visiting, and you got to consult attorneys. I mean, there's tons of good. If anyone seriously wants to look into it, I know it. There's a number of resources I could direct you to, accountants, attorneys, and I'd certainly encourage anyone who's really thinking of it, come down and visit. And it's one of the only tropical vacation spots you can get into right now because it's a U.S. territory, so you don't need a passport, you don't need to go through customs. Just get on a plane and show up.
Yeah. I'm sure your wife won't mind all of us coming over there and say hello. One guy asked the question, how'd you lose 50 pounds?
Keto, low carb. I also quit drinking for like 3 months during the lockdown. But yeah, the low carb keto diet, I loved it. I feel good. I still keep low carb. And, after 3 days, it was, there wasn't much keto flu, but it takes a couple days to adjust. And then it was great. I was off to the races.
Yeah, that's cool stuff, man. I mean, when going back and forth with you privately about that stuff, it was a huge concern that you had that you just finally made the gut-wrenching decision, and COVID kind of helped out with that, I'm sure. I appreciate it. If there's anything I can give out to the people too, Jack does have some deals that he has some slideshow. I can definitely, if you fill the form out, I'll repost the form link. I kind of put it together real quickly earlier today. I don't have the automatic email set up like I normally do, but if you do want to get on there, I can sing you his PowerPoint, Jack, if that's okay for me to send out. I can do that and allow people to, get your PowerPoint, what deals you got going on.
Yeah, they're not the one I sent you is like that's like the entire slide deck. That's sort of like a internal there. So, but I have a more condensed one. We could send a link out, and there's actually a corporate overview on the website too. If you go to the corporate overview page, that is sort of the high level one. But we could put together a custom one to send out actually for people who sign up. That there's just some slides that are just old on the one I sent you. That some of them.
I won't share that one. I'll just hook up with you later and figure that out. A couple people have done 75 pounds recently.
Nice.
Series on he's on 2 months on keto now and does 75 pounds already, which is awesome. I mean, it's I didn't mean to turn this into a weight loss competition, but it's been fun to see you get healthier. I think we all got healthier over this time.
75 is impressive. I mean, I started at 316 pounds though, so 50 was like throwing a deck chair off a cruise ship. This last 20 or 30 is going to be the harder ones. I'm starting to hit the gym, and hopefully if we do this again in a couple months, hopefully I'm as thin as you are.
Well, my wife is appreciative of the little competition we had to get us down a little bit of weight. I think I'm down 20 some pounds myself. So it's good to see. Hopefully you continue your weight loss and your healthy eating habits and whatnot. It's getting close to 6:30 here. I know this will be a happy hour. I'm sure you guys are all having a little bit of drinks on the side here. But Jack, I appreciate you tuning in and spend an hour of your time to share your state of the market, what's going on in real estate in your mind, your ideas, your experience, but a little bit about where you're at now, because a lot of investors who saw you speaking at all these no conferences over the years wonder where you went. So I know that's been a big thing. So I'm glad you kind of tuned in and let us just pick your brain for a little while and go from there. So
yeah, it was
if
great.
you guys have any additional questions, feel free to post it here, and I'll make sure to get it to Jack or whatever goes on. But again, Krup, I appreciate you joining us for a little bit, and let us know if any of you guys need to know about, and we'll pass it along.
Awesome. Thanks for having me again, Dave. This was fun. We could do it again sometime if you want. And, enjoy the rest. Everyone should enjoy the rest of your Friday night and your weekends.
All right, guys. Appreciate it.